guys, I'm Daphne Quay, your Boss Lady Realtor, and I'm here today with my good friend and lender, Alejandro Juarez.
Hi, everybody.
Today, we're going to be talking about the different type of loan programs and the most common ones that we tend to see out in the world in the market of real estate.
As a lender, we often get questions about the differences between all of these different types of loans. And the truth is that there's a very healthy mix of them. But for the most part, we're going to talk today about conventional and jumbo loans.
Yep, two loans that we see most often, or I guess that we see the most often in Austin. If you are thinking about buying a home and you have questions about these kinds of loans, leave a comment. So the two main kinds of loans that we tend to see, I think, the most in the Austin housing market is jumbo loans and conventional loans.
Yes.
Alejandro, give us very high level, like what is the difference between the two?
Main difference is going to be the loan amount. The new loan amount on standard conventional loans is $647,200. So that's gone up almost $100,000 from last year.
It did.
Everything after that is considered a jumbo loan. And the other main difference, aside from the loan amount limit, is going to be that with conventional loans, you have standard guidelines across most lenders that are determined by Fannie and Freddie Mac. And with jumbo loans, the rules are made up per each individual investor and bank. So it's kind of like the wild, wild west of lending when you go into jumbos.
With Austin's housing market being the way that it's been over the last year, we have, of course, seen home values rise significantly. So we're starting to see jumbo loans actually be more of the norm than they were before. Before we dive too deep into all of this, I'm also going to ask you to keep watching this video all the way till the end, because we're going to basically consolidate all this information and let you guys know what are the main differences between a jumbo loan and a conventional loan, so you can decide which one might potentially work better for them, right? For you and your situation. Exactly. Alejandro, talk to us about down payment options for a conventional loan.
On a standard conventional loan, you actually have a lot of options. You can go as low as 3% down on conventional loans. And the most normal is 5%. That's usually the most common loan type that we see, or the down payment that we see. But you can go anywhere from 3% on up on conventional loans.
Our next point is the types of down payment that we can use for a conventional loan.
Yeah, when it comes to types of down payment, you have to be very careful, because the funds, the assets that you're using to purchase these homes can look different on your end than the way that they're qualified on our end as a lender. You can take stocks, for example. You know, stocks are generally valued at 70% of what the true stock value is. So if you have $100,000 in stock, we can only count $70,000 of that. You have to be really careful with that sort of thing. If your lender's not doing a good job and assumes that they can use the whole lot of it, you can find yourself in a really, really big problem.
Quite the pickle.
Right. Another one that comes up are gifts. So gifts are pretty standard across the board. You're looking at people that have a direct relationship to you, that are family members, but not your friends. It can't be, you know, Joe down the street that's going to lend you $40,000 to purchase a house. That type of asset would not be allowed to purchase a home.
Really?
Yeah.
You can only be from like a family member?
It has to be from a family member.
There
are certain situations with like VA loans and FHA loans where they'll allow an extended relationship that's not a family member. But on conventional loans, I mean, it has to be a family member.
Didn't know that, guys.
It can't even be a cousin.
Really?
Yeah.
So it's got to be your mama, your daddy.
Pretty much.
Right?
Mama,
or like siblings?
Mama, daddy, brother, sister, fiance, wife, you know, that sort of thing.
Next point, what types of properties you can buy with a conventional loan?
Really important. Pretty flexible here. You can go from single family residences, condos, townhomes, manufactured homes as well. Condos get a little bit more complicated. We're not going to get too far deep into that because that probably deserves its own video itself. So if you're looking into condos, definitely send us a message.
Another one that I want to just kind of touch on real quick is multifamily homes. You can buy a multifamily home if you're going to live in it, if it's going to be your primary residence, but the down payment has to be
15%.
Let's say you're looking to buy a fourplex that could realistically be about $1 million. So you're looking at a down payment at least $150,000, which is fine, but there are other options for you with a different type of loan that we're going to bring up in another video. So just follow us along, keep watching till the end. We've got more information for you. All right, so our next point is some basic requirements for you to get a conventional loan. So the first one, let's talk about credit. What does your credit score need to be like if you're gonna get a conventional loan?
Well, the conventional loan limit hovers somewhere around 640 for most banks, for most lenders. 640 and up, you can qualify for a conventional loan, but that doesn't always mean that you're gonna get the best conventional loan. On conventional loans, you're gonna find a lot of sensitivity to your credit score. So in general, I draw the line at 700. If our clients are at 700 or above, then they can reasonably look into a conventional loan. And usually 700 and below, we're gonna probably shift to something like an FHA loan to put them in a better place. There's a lot to go when you compare those two as well. So other videos to come.
So generally credit for conventional is like high 600s.
Right.
In general. Next one is income verification. How do you guys verify income?
So income verification is the most important part, I think, of what we do. And it's probably one of the most annoying because we're calling people's HR department. We're questioning whether their W-2s are matching, their pay stubs, and people get really worked up about that. But generally all that happens is we send a request to the HR department. They fill out a form and send it back to us. A lot of companies have switched to third-party verification companies that will verify income in an instant. Online, we punch in numbers and they give us the income verification and we're done.
So our next point is going to be DTI, which stands for debt to income. Should we chat about that?
We should.
Let's do it.
Debt to income is one of my favorite topics. And if you want to watch a longer form 20-minute video about this, you can go to my website at thejuarezgroup.com. If you go to education in the top tab, there's a long video about DTI. But essentially all that DTI is debt to income. When we're approving someone, we're looking to compare what the total of that person's debt is in comparison to their income. And not only the current debt that they have, but the proposed debt that they will have when they purchase this house. So if we have a $2,000 budget for your home, we add that to your current debt. That gives us a total debt profile. And then we compare that to your income. We're looking for a percentage of somewhere around 40 to 45%. Although that doesn't mean that that's an exact limit. That's usually a healthy place for our clients to be.
Okay, so like for basic numbers, if you make $100 a month and your monthly debt without a mortgage is 20 bucks, you're at 20% DTI, and then you add another $25 for your mortgage, you are at 45%, right? DTI essentially is your monthly debt and like the percentage that is from your monthly income.
Absolutely.
It's a pretty easy concept, kind of complicated to explain.
There is something really important for you to keep in mind, that when you're talking about debt to income, the requirements for a standard conventional loan and a jumbo loan are wildly different. With a standard conventional loan, you can push up above 45%, sometimes up to 48.9. I've done some that are 49.9%. I mean, you're pushing the absolute max. With jumbo loans, you're going to see normally a threshold of 43%, which is a hard threshold. And then you see pricing, meaning interest rates, improve drastically the lower your DTI is. 38%, 35%. It's gonna improve that person's interest rate usually when you go work with jumbo investors, because it's showing that you have a much more dependable profile the higher your credit score is. Whereas with standard conventional, there's not a tremendous amount of impact with your DTI. It's more so credit related. So to simplify things, let me give you an example. Pretend that you make $5,000 a month. That is your monthly income, gross. And you will have a total of $2,500 of monthly debt. That includes the mortgage you're about to get, plus all of your monthly debts. What that would mean is that you would have a debt to income profile of 50%, because the $2,500 represents 50% of your total income. But the problem with that is that at 50% debt to income, you wouldn't qualify for a conventional loan. We would have to find ways to lower that debt to income ratio for you to qualify. It's really important that you understand that when we're evaluating your debt to income, the debts that we're taking into account are those that would show on your credit report. Credit cards, car payments, loans. Those types of things are what are being evaluated for the debt to income ratio, not things like your utilities or your Netflix bill or
gym membership.
Those are not going to show on your credit profile and would not be a part of your debt to income ratio.
So I think you can see that all the debt that's included in your DTI is like official debt that's obviously recorded in your credit report. Everything else that's left over for you to take home is living expenses. So that's everything we've got for conventional loans. So now we're moving on to jumbo loan.
As I like to call the wild, wild west of lending.
That was cute. So to start with, what is a jumbo loan? And And why would you use a jumbo loan? Jumbo loans refer to a higher loan amount, like a more expensive house. And like I mentioned at the beginning of this video, since home values have been going up so much in the last year in Austin, jumbo loans are actually becoming more and more common. We used to see tons of conventional loans go through, and now it's like conventional and jumbo. Kind of, I would say, well, you process more loans, like they're pretty much on par,
they've
right?
definitely come up, and it depends on, you know, every different lender and what their profiles look like, but I would definitely say that they're becoming way more common.
Way more common than they used to. So I guess a lot of people's questions is, what is a jumbo loan and why does it exist?
It's a great question. So jumbo loans exist because standard conventional loans are backed by our government, and they're sold on the secondary market through two large companies called Fannie and Freddie Mac, as you may have heard. Essentially what they're willing to do is secure loans up to that loan threshold, which last year was 548 and now is 647. They're not willing to go past that limit. That's where jumbo loans come in. What you end up having are individual banks and investors that are now saying, well, you know what? We'll be willing to take on that loan with our own money. Except now, because it's our money and not backed by the government or by, you know, Fannie or Freddie Mac, we can make up our own rules. And that's where things get a little bit crazy, because each individual bank will have completely different guidelines, and you have to be really careful that you're not making a mistake with your clients.
And they're really stringent guidelines. I've had several clients, and I think you have too, that go with a jumbo loan, and they think because they're buying a more expensive home and they're doing a higher down payment, that they've got all this free reign and they can kind of do whatever they want. But the reality is that the requirements and like rules for a jumbo loan are super stringent, much more so than a conventional loan.
So I would definitely agree with that, Daphne. We see that all the time. If I were to say what the main difference in a very general way between conventional and jumbo loans, it's simply that jumbo loans are way harder to get approved for. Some of the things that come up are lower debt to income thresholds, the fact that you have much more stringent credit requirements. You have to show a certain amount of trade lines for a certain amount of length of time that you've held those credit accounts. And then one of my biggest ones that I talk to all of our clients about are reserves. Almost always that jumbo loans are going to require a certain amount of reserves, usually somewhere between 6 to 12 months of that individual house's mortgage payment. So you're not only having to come with the money that you need for actual closing, you also have to have money set aside.
So if you're getting a jumbo loan, for instance, and your mortgage payment is $5,000 a month, what is that, like $60,000 for the year?
Right.
Just to reiterate what Alejandro said, right? I just did a little math problem about $5,000 a month. So you would have to have about $60,000 in savings for this particular example, or you said 6 to 12 months.
6 to 12 months is pretty normal. There are some jumbo investors that I've seen that go all the way up to 24 months.
What?
You have to be really careful, because what happens is that you get caught as a lender between two worlds, where there are some investors that are doing jumbos that are offering the best rates, and they're available. The problem is that you know that if you go and lock with that investor, you're now going to go through the ringer with the most stringent guidelines possible. And if your client doesn't qualify for them, then you might have set them up for failure. So you have to be really careful. Just buy cash. Yeah, what's the problem?
Okay, so speaking of cash, what is the jumbo limit?
So there is no jumbo limit that is standardized across the board. It depends on that individual bank. Some will go up to 2 million, some will go up to 5, some will go way past that. It just depends on that individual bank. Nothing, I can tell you right now that nothing in the jumbo world is going to be standardized across all investors. They're all going to be wildly different.
Okay, so for you guys, for loan people, is there a loan limit for a jumbo loan?
No, I wouldn't say that it's fair for us to say that there's a limit, because it just depends on the individual investor that we're going to lock with and sell the loan to. So anything jumbo, no standardized metrics at all.
Like you said, it's the wild, wild west.
Wild west.
All right, so our next point here is down payment for a jumbo loan. What do you got?
Well, when it comes to down payment for jumbo loan, there can also be a wide range of availability. There are even some jumbo loans that I've seen do 5% down. Generally, what you're going to see are really high interest rates there, and of course, absurd guidelines to approve. Those have become less common. In general, I feel like jumbo loans it's pretty fair to say 10% is the minimum down payment for most jumbos, and that is, usually where most of our clients will fall.
Okie doke. And next point, types of down payment that can be used for a jumbo loan.
So the types of down payment is very similar to that of a conventional loan. You're looking at your own assets, checking and savings accounts. You're looking at things like stocks. You can even use gifts on jumbo loans as well.
You can?
You can.
I did not know that either.
Absolutely.
I'm learning so much. Why is it important to get like a gift fund instead of just like having your mom or dad like just deposit, I don't know, $150,000 into your bank account? Like, why is that important?
That's a great question. There's also something else I want to add about gifts before I get into that. It's really interesting because there's also a lot of variation in the amount of gift you can get with jumbo loans.
Okay.
Some jumbo loan investors will only let you get a certain amount of gift based off of how much of your own money you're contributing towards the loan.
Okay.
So if you're only putting your like 3% of your own money and the rest of it is gift, they might not allow that. But if you're putting 10% down and they're getting the rest somewhere else, then that's totally fine. So it, again, completely varies. Now, as it pertains to how you receive this money, you can do this in a couple of different ways. My preference and the easiest route for everyone is to do what is called getting a gift letter, have the donor sign that they are gonna gift this money, and have that person send the money to the title company at closing. Because the other method, which would be mom and dad writing a check and depositing into your account, can be a little bit cumbersome. Essentially what that triggers is a requirement for us to source where the funds have come from. And in some cases, and it also again depends on the investor, they may even require for that donor to provide copies of their bank statements so that we can prove the money was actually theirs. If you send the money directly to title, that condition is almost never a part of the underwriting list of conditions. And so it's usually much easier for that money directly to go to title company and never come into possession of the client or the borrower.
There you go. One of the last points that we covered in conventional loans that we didn't cover yet is where does your credit need to be at if you're gonna buy a home with a jumbo loan?
I mean, obviously, especially with jumbo loans, I feel like they're very sensitive here. You wanna have as high credit score as you possibly can. It is true though that with a jumbo loan, at least not one that I've ever seen, go below a 700 credit score at all.
Okay.
So they could be 699 and you could look, I've looked for jumbo loans everywhere. I've never found a jumbo loan, at least a normal one, that's gonna be approvable with less than a 700 credit score.
A lot of the subscribers that watch this channel and that are watching the videos in general come from out of state, and I'd say a large majority of you guys are coming from California. So let's just kind of talk a little bit, like very high level, very, very quickly about the difference in jumbo loans in California versus here, as much as you can.
Yeah, absolutely. It's definitely a state that I'm not licensed in, so I don't want to get too carried away talking about it. But one of the things that we know is that oftentimes when people are coming to Austin, they're not really used to the jumbo loan conversation because the limits are different in many areas in California as they are here in Austin. In those areas, you have what are called high cost areas that allow for much larger conventional loan limits than the standard 647 that we have here. So where you would have someone in California purchasing a home, not jumbo, they could come and purchase a home at that same amount, same exact sales price, but in Texas, and now it's a jumbo because they're in a completely different place. So those are things that we want to prepare everybody for because you will encounter that.
And one of our last points, we're going to talk about DTI, debt to income ratio for jumbo. Take it away.
Yeah, so DTI you want to be really careful with jumbo. You want to make sure and you're talking to your lender to get an idea of where that debt to income ratio puts you in terms of approvability, in terms of pricing for interest rates, because jumbo loans are really sensitive to debt to income ratio. As I mentioned before, with a standard conventional loan, you can comfortably go to about 45%. Sometimes you can push a little bit higher, 46, 47, 48. But with a jumbo loan, you almost always see the threshold be right around 43% for a debt to income ratio. That's not always the case, but that's a pretty close to being normal range for debt to income ratio. The lower your DTI, the better almost everything is gonna be when it comes to jumbo loans.
All right, guys, so that's all the information that we have about conventional loans and jumbo loans. We do have another video coming up about FHA and VA loans, so please make sure to subscribe and hit the notification button so you can be notified when we have a video like this one. Anyway,
if you want to check out some more mortgage-related videos, we've got some longer form ones on my website at www.thejuarezgroup.com. Check them out.
Yes. Anyway, I'm Daphne Quay. This is my good friend, Alejandro Juarez. Hey! Anyway, I'm Daphne Quay, your Boss Lady Realtor. Thank you so much for watching. Till next time.
Bye.